Hey everyone, and welcome to another episode of the Clopton Capital CRE podcast. Today joining us is Eric Enloe from JLL. Eric leads the JLL Capital Markets valuation platform in the US. He directs valuation and consulting engagements related to a wide variety of property types in the Chicago market and national institutional assets, and has a broad range of experience in the valuation and analysis of all commercial asset types. So, Eric, listen, appreciate you jumping on, and I'd love for you to give us, a little bit more background and how you got to where you are and how things are going today.
Sure. Yeah. No, thank you, Jake. Appreciate it. Thanks for the opportunity to be on today. I got into the commercial valuation space. This was in 1998, which makes me feel extremely old, but that is the reality. That's when I got into the business. I grew up in Kansas City. I started in the valuation space in Kansas City after I graduated from Notre Dame, and worked there for about 6 or 7 years. Found a fantastic mentor in Kansas City who was a developer, a real estate broker, and an appraiser. So I learned from somebody that just had a really diverse background in what he had done in the past, and he ended up being actually one of the premier real estate appraisers in the country. I didn't know it at the time when I was 23 years old, getting hired right out of school, but it's extremely well known as an appraiser nationally, with a real focus in regional malls and kind of complex retail at the time. But gave me a really great background in learning aspects of development, property ownership, and all different things. And then after that, I moved. After kind of that 5-6 years in Kansas City, I had an opportunity to expand our Chicago office. We had 3 or 4 people on our team. At that time, it was Integra Realty Resources, and we were able to grow that team to close to 25 people over a roughly 10-year period. Now we're closer to 32, 33 people on our team here at JLL. But that's really my background, handling both projects in Chicago, but a national focus that I have, running the capital markets valuation team and working with our team in Dallas and DC and New York and West Coast, LA, San Fran. So that's really kind of a little bit background on me.
Nice. Good. No, I appreciate it. So this is kind of a broad question, but I don't think a lot of people have a lot of insight outside of appraisals in the subsector of the appraisal industry and commercial real estate. So like during the pandemic and everything that was going on last year, like how were appraisers directly affected by what was going on, right? And then like how was kind of business at that time?
Yeah, great question, Jake. So what we find in the valuation space is we are really busy when the real estate markets are healthy. So when there is a lot of financing activity, which obviously is related to interest rates, but other factors too, employment and all kinds of things. But when financing activity is strong, appraisers are busy. When acquisition activity, which is related to financing, obviously, when acquisition activity is strong, appraisers are busy. So when markets are healthy, we're seeing growth. So you look at industrial right now is a great example, right? But kind of going back to COVID and that circumstance, when COVID hit our industry. So let me get the flip side. When appraisers aren't busy is when things are somewhat frozen. Right. So when things lock up. So really busy when things are really good. Also really busy when things are really bad. So think bank failures, extremely busy, one of the busiest times of my career. So when things are really good or really bad, we're extremely busy. When people kind of freeze up because there's uncertainty, we go slow, right? The business slows down. And so, when March, April hit with COVID 2020, our business absolutely froze because financing deals that were under contract, a lot of them died. Financing activity slowed up. So, the months of March, April, May, June were challenging months. They were really, really challenging months where, in some of those days, you didn't know if the sun was coming up. Now,
Sure.
fortunately, clearly it did. But as time got on, as the year went on in 2020, we started to see a little bit of ramp up in July, started to see a little more in August, got a little bit better. Got a little bit better in September. Just volumes continued. There were some people comfortable making acquisitions, primarily industrial, single tenant, long-term lease office, multifamily in the suburban areas started to improve. So September, October just continues to get better each month. And really by November, December, we were incredibly busy because there was some pent-up demand from deals that didn't get done that were now resuscitated. But there was a pipeline where, companies in logistics, industrial, that was very active. The Dollar Generals of the world, where the triple net space was performing well. Walgreens and Dollar General, felt like there was safety in that space. And then also suburban multifamily became very active, as unfortunately quite a few of the tenants in urban areas and apartments relocated to the suburbs, wanted more space. We saw activity. 2021 has been a very active year, all starting in January. It's been a really strong year for valuations, throughout the year. I would say the only other aspect of valuation that I think is kind of interesting is we do pension fund work where we value assets for, big, large institutions like a TIA Craft, Nuveen, Prudential, Invesco, on these different firms. Well, they have to value their assets quarterly.
Okay.
And whether it's a good market, bad market, uncertain market, they have to give disclosure of what these properties are worth. So we do sign contracts where we value assets every quarter for 2 years, 3-year contracts. That work did continue during COVID. It's challenging to value during COVID, clearly, but that work did continue. But the acquisition and financing activity did become challenging. Really there from March through June was it just the uncertainty and like I said, when we get slow and our activity goes down, it's just when the markets freeze and there's uncertainty.
Right, and I think you brought a good point there because the capital markets. I don't think a lot of people realize we're actually really healthy through all of COVID, right? I mean, banks were healthy. There's lots of liquidity. The Fed, Treasury stepped in, bought assets and stuff. Really just that uncertainty that, was kind of freezing the markets. And it sounds like that really started to, alleviate around like third quarter or something like that is when you're saying a lot of activity started picking up.
That's exactly right. Third and fourth quarter were, especially fourth quarter, I would say fourth quarter was robust.
Okay.
But third quarter was there was recovery without question in third quarter. So yeah, that's really, what we saw.
Right. So I mean, as far as like this year, as far as like coming out of the pandemic, obviously there's a lot more liquidity in the system, right? I think there's $5 trillion extra dollars or something like that out there versus 2019. I mean, are you seeing, yourselves like much busier than even before, in 2019, or is it kind of on par, or what was the activity look like?
Yeah, in my 20 plus year career, I could probably count a handful of times where we've been as busy as we are now.
Oh, wow.
And it is extremely active. There's a lot of money chasing deals, to your point, right? There's a lot of capital out there. There's a lot of equity capital out there. There's a lot of debt capital available out there. But the foreign investor is back. That's another component. So on larger institutional projects, I visit a lot with our investment sales team on the industrial side, visit with them weekly. And they are getting new listings every week. They're closing on assets every week. And the bidder pool can be 10 buyers, 20 buyers, 30 buyers, 40 buyers. And it is unbelievable how many rounds that they go through. And then they're also getting buyers that will come to them and try and kind of circumvent the process and say, here's my number, but I need you to take it off the table today.
Okay.
That's it. So there's buyers coming in trying to circumvent the process. I was even getting information from our team on what I'm also seeing is it's a forward. Essentially, you have a land site, but there may be a lease that's been signed for, say, a FedEx or an large, I can't say the firm, but large e-retailer that we all know, and you're holding that lease and it's in hand, and the building hasn't even started construction, but firms committing to purchase that asset when it's a completed industrial building with that lease in hand a year and a half from now, but construction hasn't even started.
All right, so they're subscribing to deals like just to take it off the street before the thing even exists.
Before it even exists.
Right. So well, I guess that kind of answers the next question is, like the bids and the asks, right? I mean, it sounds like there's a lot more movement on the bids than the asks in the market, right? And I'm kind of seeing that too. Yeah.
Totally agree, right? There is tremendous buyer activity. In many cases, real estate brokers, investment sales brokers are optimistic by nature.
Sure.
They want to achieve high prices for their clients, and that's a great thing. Even that optimism of what investment sales brokers are saying that they anticipate getting for pricing, that is getting beat by 5-10% in some cases. And those are already optimistic pricing. It's already getting beat, which is fantastic for owners. I mean,
Sure.
They're getting more proceeds than they were anticipating. But that it's not that uncommon for that to occur. I mean, normally if someone asks $100 million, you may get 95 million, right? Or you get something below it. And now you're asking $100 million, you may get 105 million.
Sure.
It's just,
I mean, that's a concept you used to see a lot in like residential, right? Like houses going for above ask because there's a bidding war. And I didn't usually see that in commercial much, right? I mean, usually you try to come down from whatever the list or the ask was, right? But yeah, no, I've seen the sales above list and above ask. So that's definitely interesting. So here's a good question: who do you think's getting the better deal, right? Is it the seller that's getting the great deal, or is the buyer that's getting the good deal paying up because maybe, right? Because there's got to be, a conflicting thesis there on both sides. And maybe the buyers, are seeing asset inflation into the future and rent growth, and then really even paying above ask today is a discount versus what's coming in the future because of all the liquidity and all this stuff. Like, how do you guys kind of look at that?
Yeah, that's a great question, Jake. And I'm going to give maybe a couple different prongs to that answer. Yeah. I think that, these institutional owners, develop product or buy product in the past, say 5 years ago with, defined holding periods. They want to own it for 5 years, and they want to own it for 7 years, and they want to, achieve this yield from the investment, and that's their target. And they set these targets. So, in this market, and this isn't all property types too, right? I mean, I feel like we're talking a little bit about industrial, which is the hottest market I've seen in my career. Right. But I mean, it applies to other things. I mean, we're seeing a ton of activity on single tenant, long-term lease office. There's been some significant trades there too. But, these sellers have their defined targets and hurdles. They may even be getting above what their asking price is, which certainly they're meeting their yields and their targets. So they feel good and they feel like they've won. The buyer who's paying above ask and, they paying above market. That's one thing I get asked, what's market value? Well,
as somebody will pay for it,
right? That's exactly right. Right. And I don't make markets, right? As an appraiser or valuer, I'm my job is to mimic market activity. It's to value something how buyers and sellers would look at it and how it would be approached. So I don't make markets, buyers and sellers do. And so I need to, as closely as possible, reflect market activity. And if market activity is 5% above ask right now on this asset type, or it's that, who am I to say if if a full process was run to where a package was put out there was a round one, round two buyers, it was exposed to the market, and here's where it's landed. It's pretty tough for me to go, yeah, I don't think that's really a market price when 100 groups looked at it and could have made offers. So that's, I guess, a little bit of my common sense aspect of looking at valuing real estate. Is that buyer getting a good deal? I think there's a couple things to that I've been thinking about. Number one, I've seen a few buyers say, you know what, I'm going to take a pass. I'm at my max number. I'm going to take a pass. I'm going to pivot now. And instead of, where I have to buy this, say my cap rate would be a 4, 3.5, 4. So, a low yield, looking at their overall yield, that's cap rate, but looking at yield, I'm better off developing industrial, right? In this case. So I'm going to try and I'm going to develop, and maybe the yield, if they're paying a 3.5, 4 cap rate, maybe their rate of return is a 4.5, call it a 4.5, 5 on that. They say, well, I'm now going to develop and try and earn a 7 or an 8 yield. That's my goal. So I'm going to pivot there. I think it's a pretty interesting strategy and a good one. Now,
not everybody can do that, though.
First off, not everybody can do that. You're right. But the second one is construction costs have gone up so much here in the last 90 to 120 days, that it's tough to pencil out to make those numbers work. And, the reason you get the 7 or 8 yield is you're taking lease up risk, and there's different construction risk, interest rate risk. There's different things that go with it. But I mean, you don't know none of us know exactly what's going to happen in 6 months, 12 months, 18 months. So there's more risk. You get more yield, but more risk. But with construction costs going up, that's even made that even a little bit challenging. So I think it's interesting. Are they getting a good deal? To, eyes of the beholder, but many probably feel like they're getting a deal because they don't want to take on that development risk. And the other aspect that it hasn't been prevalent around the country, but it is occurring now, but on industrial, we're seeing rental rate growth.
Right.
So in many cases, you just haven't seen rental rate growth in the Midwest. Not significant rental rate growth in years, maybe a few isolated submarkets, but generally in areas like the Midwest, you have abundant land and you just don't see pop in rental rates, where historically you do see rental rate growth in Northern New Jersey, Inland Empire, two of the hottest markets for industrial. You've seen rental rate growth, seeing it extreme rental rate growth right now. But in the past, you've seen it, but in other areas of the country, you just don't see rental rate growth, and we're seeing it. So that's enabling buyers to pay when they're doing their underwriting models to figure out what to pay. They're increasing their rent growth that helps them kind of get to those numbers. So that's a real difference in the current market that I'm seeing. So
right, and maybe that we see additional cap rate suppression, right? Because with more construction costs, input price hikes, that barrier to new product coming in, right, just becomes even higher and higher. And if you want access to those markets and those assets, that the pool obviously becomes a little thinner, right? So, that's interesting.
No, it's really interesting, and part of the construction cost increase is raw materials, but part of it's labor and finding the labor to build the buildings, and that's part of the cost increase. So it's one thing to say you can build a building, but if you can't find the people and the staffing to build a building, you're not building a building. I mean, you can't, they just don't go up on their own. And so there's tremendous activity, but there's a level of strain, I think, in the market too, like some of the labor and it's pretty interesting what's going on. Even, some of the third party, I mean, us providing valuation services as part of a transaction. Well, there's also property condition reports and environmental and Alta surveys that go with whether it's acquisition or refinance. A lot of those service providers are backed up, and it's impacting transactions. So the timing of closings, which you really don't want that. You want buyers and sellers to be working through transactions and financings and be able to close exactly when you're supposed to close. But there is a little bit of strain in the system due to just capacity right now. So it's interesting.
So when you're valuing an asset, let's take like multifamily, for example, right now, and given everything that right, the marching orders of the Fed and the government today is more inflation, wage growth, right, in the system, and eventually that obviously it filters down to inflation everywhere, rental rate growth, and in pretty much everywhere. Are you guys kind of taking that into account when valuing assets today, knowing that that's coming in the future, and that like that's really being pushed on a macro level, basically to push through the economy, and knowing that there is significant rent growth probably coming, in the short to near term?
Yeah. So short answer is yes. So we're trying to, factor in, a multitude. We kind of put a lot of different factors into a pot, right? Kind of stir it around and factor that in. But there are some interesting, inflation trends that are out there. We're seeing wage growth. The rental rate growth is occurring in multifamily, especially in the suburbs. And urban areas have really struggled. They struggled in 2020 as people, left cities because, one major reason people live in urban areas is to be close to work. And if they weren't going into work, the urban area just didn't have as much appeal. Plus, the other reason, or a reason that people live in urban areas is entertainment aspect and going to bars and restaurants and museums and sporting events. And a lot of those weren't occurring. So from that aspect, it was really the urban areas have been challenged, but in the last really 4 to 5 months, we've seen a real draw back into the cities as some people have gone back to work. But even if folks aren't back in the work yet, in their physical office yet, they know it's coming. And I feel like everyone, at first it was Memorial Day, then it was July 4th, and then it was Labor Day, right? Everyone has these targets and they continue to shift, but people will be getting back to work in force. So we've seen the urban areas kind of bounce back, and we're seeing occupancy increase, free rent decrease. So we're seeing real positive trends. But in getting back to your question on valuations and how we're looking at it, without question, we're factoring in rent growth. We have wage growth, anticipated too, but the rent growth that we're seeing, and it's more extreme in other areas. But we've seen record cap rates for suburban multifamily. I mean, it is, and that is not just in the suburbs of New Jersey or in the suburbs of California is almost a market in itself. But we've seen really, really aggressive cap rates with Chicago multifamily, in Phoenix, in Atlanta. Atlanta and Phoenix, these are markets where there's plenty of land available. You can pretty much, go in any direction. And we've seen record low cap rates in those markets, especially, Sunbelt's been really active. Florida's been really active. Seeing significant rent growth in Florida. Part of that's migration from New York, Connecticut, moving to Florida. Phoenix, state of Arizona has really always benefited, and state of Nevada have always benefited from people leaving the state of California, which is just an expensive place to do business. But it's an interesting dynamic out there, but we certainly look at the overall economy and those macro factors in our valuations. And it really depends by property type as well, looking at when you have, specific drivers of, say, for instance, multifamily, it's employment driven, right? Those are the main. So what employers are moving in, what employers are moving out, are they growing? And overall, I mean, the stock market's it's obviously retrenched a little bit here recently, but it's at unbelievable levels, and corporate earnings are strong. And it's pretty incredible, the activity we're seeing right now.
Sure. Yeah. I mean, some of the cap rates, like I'm starting to see out there, it's like cap rates you used to only see in like California and Seattle or New York City. It's like, oh, well, those are different, right? I mean, those are those cap rates. But now, I'm starting to see those in other places, and it's like, well, why not here, right? Like there's more liquidity out in the system, and it obviously is supporting it. So here's a question for you. So every pro forma I've seen in the past like 20 years had some sort of rent growth metric of 2%, right? Every year, and it never changes. Is that changing going forward? To me, I think that's got to get bumped up a little bit. If that's just our inflationary rent growth, in pro formas, and I'm still seeing that today. I'm starting to think that that needs to creep up a little bit, especially for the next couple of years. And I think that may be part of what's driving bids over ask, with some of these buyers.
The old standard, let's grow revenue at 2% and let's grow expenses at 2%. So they offset, right?
Well, the expenses are definitely growing faster than 2%. Chicago taxes sure are. So.
That's true, right? Yeah. But I mean, if you're at 2% revenue growth and you're at 3 or 4% expense, right? Then you're going
the wrong way.
8 ball, right? You're going the wrong way. Yeah. So. But yeah, in short, we are seeing above that 2% or even a 3% rent growth. Those are, I would say, are kind of the standard rent growth assumptions. We're seeing in some markets going 4%, going 5%. Taking that to levels. I'll tell you, in some industrial markets, in the first year or two, we're seeing 6 or 7% rent growth.
Oh wow, okay.
So I mean, really strong, and that's pretty isolated in northern New Jersey. Inland Empire on California, some of the best, but no, to have rent growth of 4% for a year, maybe it's 3.5% year 2, to have these rent projections that exceed historical norms is something we're using in our models, depending on market and submarket, depending on the asset and the quality of it. Class A can operate different than Class B for some multi and different things and what the drivers are, but we're seeing pretty incredible activity. And I do think, to your earlier point, that is what's driving some of these offers that are above ask and really strong. So we're absolutely seeing that. Absolutely.
Right. It's interesting. So another question for you, we touched on like downtown areas. How do you value those today?
Downtown.
There's a lot of uncertainty, right? And like, how did they held up like during the pandemic, right? I mean, I didn't see people, fire sailing assets. I didn't see asset deflation, right? So maybe rents came down a little bit, or maybe they had a blip, but I just didn't see, like stamps, like price stamps on assets that were getting fire sale. And there haven't been all these foreclosures and all. I mean, obviously a lot of it has to do with like government intervention and, stuff like that. But how are values kind of holding up in relation to these downtown assets and core assets?
Kind of on the multi side, is that?
Yeah, multifamily in general, yeah.
So, multi's been really interesting during COVID, and a lot of the larger REITs and owners nationally repositioned their portfolio in 2018, 2019, 2020. It would have been early 2020, but they kind of had these mandates kind of, 18, 19, 20, that they wanted to be in urban areas and they wanted to be in constrained markets where it was harder to develop. Kind of control supply demand a little bit, because it's tough to build apartments in New York. It takes a while. It's really hard in San Francisco. So they got rid of kind of their maybe tertiary locations and their assets that weren't the best, and kind of had prime assets in big markets and that normally means urban areas, because they felt like they could get better rent growth. And so they repositioned their portfolios. Then COVID hits, and that's exactly what got hit the hardest, is what I described, and how they repositioned their portfolio into a mix that was challenged. And
the assets they thought were the safest,
because they thought it was the safest,
the worst ones to hold at the time.
And who would have known, right, about COVID and that it would kind of flip things upside down. So what we saw in a lot of markets a couple different things. Rent growth go down anywhere from 5% to 15%. That's a pretty big range, but especially in markets that the larger markets, New York, Chicago, San Fran, that that it was hit harder on rent declines in the bigger markets. The other component was markets that relied upon public transportation were hit harder. So you would think, once again, these big owners, they focus on large markets that are constrained, urban, public transportation, places everyone wants to be. And
public transportation right outside, close by.
There you go, right? And so public transportation, those markets that are heavily public transportation reliant got hit harder. The other component was free rent. That is often, in some markets, no free rent, but a month, 2 months, 3 months, it went. Whereas maybe it was before 0 to 1 month, it went to 2 months, 3 months. I mean, there's some markets that were offering 3.5 months free.
Yeah.
Now it wasn't a 12-month lease anymore. They would sign a 15-month lease, but you're still getting 2-3 months free. So the effective rent, or really the return to the owner, was really hit. Difference between what we've seen during COVID and say maybe financial crisis 08, 09, where lending activity absolutely froze. There were runs on banks, Lehman going down, all of that activity was the banks held firm, right? They didn't, they tried, to negotiate and work with owners of properties in multifamily, but in other property types too, to, figure out alternative payment plans, to just kind of keep things going to where there weren't mass foreclosures. Now there's
I don't think they really had a choice. It's not like you could go to the court, right, and try to file a foreclosure. Like,
many cases you couldn't go to the court. The courts were closed. In many cases, those states had regulations that said, you can't foreclose in this time frame. You've got to work with the borrowers. Where we did see assets go into special servicing, especially CMBS deals, that there's not as much flexibility with those. They went into special servicing. It's been primarily hotels and retail.
Yep.
There's some stats out there. I think it's 83% of the assets, 85% of the assets in special servicing are either hotels or retail. If you segment that even further, a high percentage of that retail are malls. So, the devil's kind of in the numbers and slicing and dicing it. But multifamily saw a downturn that no one anticipated. And it was really urban based. Rents went down. Expenses generally did not get down. Some of the usage things where you could control electrical because your common areas, because your gyms were closed, so you didn't use electrical. So some of the amenity spaces, but we're seeing a great comeback. So we're seeing a great return on the multi side in urban areas, to where there's some assets listed for sale in urban markets, because there were very few trades during COVID, but there's some assets listed, some multifamily assets listed in urban areas, and we'll see what happens and see where those trade at. But I think they're going to get pretty good numbers. Part of that is suburban is so healthy and expensive that I think there will be some slight opportunities in urban areas to maybe get in at pricing that in a few years people will be stepping back going, I feel pretty good about my entry price into this, because I believe in urban areas long term. I may be slightly biased. I live in an urban area, but I do believe in it. And the main thing is the infrastructure that's in. You can't replace the public amenities, these parks, the sporting venues. The main renter pool is 24-year-olds to 37-year-olds. That's the prime renter pool. And I'm not convinced they don't want to be in an urban environment where they're near a lakefront, near sporting venues, near bars and restaurants, where there's a heck of a lot of other 25 to 37-year-olds all hanging out together, having fun. Sure. I don't think that's gone away.
Well, if you go to the urban areas like downtown Chicago or Nashville, wherever right now, those areas are slammed, right? They are as busy as they could be. right now, the restaurants and, all the entertainment stuff. So it's hard to see that the rest of it won't come back and people are not feeling comfortable, right? Like I just don't see that. I mean, if you're comfortable enough to be in a crowded bar, right? I mean, I feel like you're comfortable enough to live downtown, right? So, that's interesting. So, next kind of question I had for you is like, what are a
Sorry,
couple?
Jake, my internet appears to be a little.
Oh, don't worry. We'll edit this out if later on if.
What your question was, extremely busy in urban areas. If you go down there and you see people everywhere at restaurants and bars, maybe the office environment isn't at full speed yet, but we're seeing a lot of activity. That is 100% my experience as well. So
Right.
Try getting a restaurant reservation on a Friday or Saturday night at a busy place, and it is as hard as it's ever been,
It's
if not the hardest.
You better do it 3 weeks ahead, and you have to pay for the reservation now, which is the interesting thing. So, yeah,
Right.
that's a new one I've seen. Which is interesting.
Yeah. Right.
Yeah.
So there's clearly that demand. Some of those people are coming from the suburbs. Some of them live downtown, but there's that return to downtown that. And I remember the first few times I went out to dinner, and I was just a little bit shocked. Right. I just hadn't been around that many people or seen people grouping, but there's a lot of people that are comfortable with it, and that's great. Everyone, can make personal choices, but there's clearly a lot of personal choices being made to get together in large groups and gatherings, and weddings are back. Event spaces. So many weddings were pushed off, and anniversary parties and all. I mean, it's hard finding event spaces. It's pretty incredible what's going on. There's been a real return to the city, and it's pretty staggering, just the amount of activity. With the leisure traveler, it's interesting because we do work in the hotel space. The leisure traveler vacations, that traveler is out there, right? That activity. Airports are busy. I was in 2 different airports.
They're out
I was in
there
3 different airports.
More than ever. Absolutely.
More than ever, right? There was that pent up demand, and they're out there more than ever. The business traveler is a little bit different story, in that there's not as much business travel going on. But the business traveler is getting out there, but that hasn't returned in full force. And we'll see with Zoom and the other options. Business travel will definitely return at a higher level, I believe. But I don't know if it'll be back to quite where it was, but certainly leisure is back in spades.
Yeah, I mean, I think it may take a little time for the business guys, right? But it's only going to take one guy, right, to go on a business trip and get in front of everybody, and then all of a sudden, all his competitors have to do it, right? And then, the business travelers are traveling. They're also the leisure travelers. They're going on vacation. So I think the comfort level thing is like, I don't know if that's really an argument anymore, right? Because you've got more people traveling than ever, and it's going to be a lot of the same people that are business traveling also. So, I mean, we'll see, but I'm I'm on the side of, business travel comes back, people go back to offices eventually, and we shall see. So, question for you: if you were to pick a couple of markets and a couple of asset types in those markets today that, like investors, where you think will outperform relative to other markets and other asset types, like what would that be? Like your top 3 that you're seeing the most activity, the most growth, and what are those areas?
Some markets I like, generally for activity. I think Raleigh, Durham, that triangle, that area, incredible. Fantastic life science presence. Apple just announced significant number of jobs that are they're going to operate a large base there. Fantastic university presence, with UNC Chapel Hill, with Duke, with Wake Forest. I think that's a market that will really grow. Another one that I like Phoenix. Phoenix is an interesting market in that it has highs and lows. But I think they're on the right track. They've had some really strong employment. It's a good distribution market as well. Climate is obviously really, really good in the winter, a little warm in the summer. But they've added amenities, and that's a market that that I really like. I think there's a lot of opportunity there. I think you have to look at the states that have favorable tax environments, and that's one thing that we've seen throughout the state of Florida. There's been in migration to the state of Florida. Not saying it's all tax driven, but it's a factor. We don't have state income tax. State of Nevada would be another example. I think that on the flip side, you've got to look at states that are expensive to do business in, and they're going to be a little bit under fire, I think, for a while. I think the last one, and this is one that I think most people probably know about, is anywhere in the state of Texas.
Yeah.
Seeing tremendous demand generators in the state of Texas. Austin has been a favorite market for years for institutional investors. It's with UT Austin there, with Dell's big presence there. Apple has a presence there. I mean, there's just a lot of positive momentum in Austin, but in a bigger market and more of a financial center, Dallas is performing great.
Right.
Seeing really strong multifamily growth, corporate growth. So there's just a lot of positives in, I would say, Dallas as well. Houston, certainly people think of Houston, they think of oil and those big companies, and that's part of the economy there. But Houston also has some pretty good demand generators.
A lot more.
I mean, those would be some of them that come to mind.
Yeah.
There's a lot more going on. I think and I'm going a little off memory. I think Houston is the 6th or 7th largest city in the country. So
right. I have that argument all the time. It's not just oil. Right.
It's not just oil in Houston. And yes, when you think of the financial firms, JP Morgan Chase has a huge presence in Dallas. Their big campus out at I can't think of the spot, but they have a big presence. But financial firms feel like people feel like, yeah, there's more of that in Dallas, and that's true. But there's a lot of big industry in Houston, and it's a lot more diversified economy, I think, than people realize.
Sure.
So yeah, those would be some of the main ones. Over time, I love New York City. I believe in that market. It's the financial capital of the world. People will return to the city, and it will be extremely vibrant again. San Francisco, the same way. It's just a slower recovery in those markets.
Gotcha. No, that's good intel. Appreciate it. So if you were to pick, and knowing that you look at values all day long, if you were to pick one asset type, kind of size in a market that you would buy, like what would it be?
I would pick, I think there's some, what's interesting that I find is some of the secondary markets do not compete. And let's say office assets don't trade in Columbus like they would in Chicago, right, or New York or Philly, and these Boston, LA, the bigger markets. There's a real, I think, a little bit of bifurcation in secondary markets. But what I found is secondary markets for industrial can be almost every bit as vibrant as the larger markets. So we're seeing industrial trade at really aggressive cap rates in Columbus, in Indy, in Minneapolis, in Kansas City, in St. Louis. Some of these markets can be a little bit sleepy overall, not on industrial right now. So I think that there's some interesting buys in that space that on the secondary market, secondary, tertiary market industrial that I think are real opportunities. I would say that's one. I do think urban multifamily represents an opportunity to buy in the larger markets like New York, like Chicago, like San Fran, because I don't think that pricing is caught up with suburban pricing. So I think that would be another place. I haven't talked a whole lot about retail, but retail, they were clearly under fire. I think we're through most of the bankruptcies that were going to occur, and we're actually starting to hear about retailers want to add locations, which is a real positive. We want them to be expanding. And, Target and Costco and Walmart, Home Depot, they all did really well during the pandemic. And it was more the smaller boutique retailers, the clothing companies that struggled. But we're seeing some of those non-Target, Costco, Home Depot actually want to add stores and add footprint. That's a really positive thing. So I think there's some opportunities in power centers and community centers. Clearly, grocery anchored has performed extremely well. But I think there's some opportunities in retail that, there's still a little bit of a hangover on retail from, the challenges that occurred in 2020. I see some opportunity there, and we're seeing values increase on retail, but I'm not sure retail's not going anywhere. People want that experience of going out and buying items. Certainly online is a great option, and online usage has increased partially during COVID because you didn't have a choice. But I think people are making a personal choice to buy items online, but retail's far from dead in my book.
I mean, there's there's certain things you can only do at a retail center, right? Like every time I, and I kind of laugh about this, but every time I see a little strip center with a nail salon in it, I'm like, man, that might be your best tenant. They might be there 30 years, right? But your national guy might leave after 5, and also he's gonna hamstring you on free rent and all this, So
yeah, I think there's opportunities in retail. I guess I'm a little bit of a contrarian in how I look at things, but I think there's a little bit of opportunity in select retail, but I think it's getting back to the basics, and it's, does it draw from a 1 mile radius? Does it draw from a 3 mile radius? What kind of center is it? A mall might drive from a 15 mile radius, but if it's a smaller, strip center, community center, is probably a 1 mile radius, a 3 mile radius. What are the incomes in that area, right? What's average household income? Is the population growing? Is it declining? Like what's going on there? Because to me, that's super important to really kind of understanding those dynamics, because that's really at the crux of kind of what value. And over the long term, if you're, where we see mall space has clearly been really challenged, but we see locations where you have a mall, but there's good fundamentals. That mall will get redeveloped, and it may change, but it will get redeveloped into some use that's a positive one and will be impactful. It's where you see a mall that has really challenging demographics, low household incomes, population that is leaving the area. Those are tougher situations, but it's kind of peeling back the layers to understand, what are the demand drivers and what's going on. But I think retail can be a little bit mispriced.
Yeah, their malls are interesting. Like certain malls, like the Schaumburg Mall out here, I think does it really well, right? They've got all the experiential stuff. That place is busy every day. They draw people in to lots of events, and then there just so happen to be all these stores around them, right? And then, there is other malls like suburban enclosed malls, which are really just physical distribution centers for retailers, for people that live in that area, which are just not really necessary anymore. And those are the ones that are having like all the trouble, right? For the most part. And I think, if you look at special servicing, the vast majority of retail that's in there is suburban enclosed malls that just don't really need to be there anymore. So.
Yeah, it's a very bifurcated market on malls. You really kind of have the haves and unfortunately the have-nots, and a lot of the mall assets that are in special servicing are the have-nots. That's the reality of it. And it's really, really hard in the mall space when you have a Sears that was not only 100,000 square feet, but if you have one that's 250,000 square feet and it's over 2 floors, I mean, how do you backfill that? And it just coming up with, do you put a hotel in there? Do you put residential in there? Do you break it up into 5 tenants? Okay, well, maybe you break it up into 5 tenants, but those 5 tenants, no one will want the second floor. So immediately your 250,000 square foot box cut it in half, assuming the floor plate is an even 125 on each floor. So you have 125,000 square feet of rentable space instead of 250. So your rent that maybe Sears was paying you $4 or $5 in rent for the entire box, now you're going to get higher rents. That's a good thing. Maybe you can get $15, $20, $30 for each of your 5 tenants, but it's off of 125,000 square feet instead of 250,000 square feet. And you also had to spend $125 to $150 a foot to retrofit that space to get it ready for those tenants. So challenging on these big anchors to figure out what uses go in there and really make economic sense. And distribution gets talked about a lot, and whether that's a store, but you can do pickup, and a lot of it's a warehouse. I think that's a model that works, and we'll see more and more of that. I've been really impressed how Best Buy has pivoted. I think you asked me 7-8 years ago, what were the prospects for Best Buy? They were in serious financial trouble, and the prospects were not very good. They've really pivoted their model, and they're doing pretty darn well. So I think these retailers will have to evolve and just continue to evolve in their business. And I think COVID, in many ways, it accentuated who the strong retailers are, and it showed the real weakness in the retailers that aren't as well managed, and maybe their business plan isn't as sound.
So. Right. Yeah, I think it was really the great trend accelerator. Right. Well, listen, Eric, man, I guess we'll start to wrap up. I really appreciate you jumping on. I think it was phenomenal information, and I think a lot of people will find it valuable. How can people get in touch with you if they have questions or want to chat?
Yeah, my email address is eric.enloe@am, that's applemary.jll.com. So anything I can do to help. I appreciate you